Hey, it's Chris Hobart, the Wealthologist, with your weekly Wealthologist update. Now, it is that time of year when Wall Street begins to roll out the crystal balls, the bold calls, and the top 10 predictions of the year ahead. Now, some of those predictions, they age really well, and some of them, let's face it, we hope that people quietly forget by March. Now, today, I want to walk through a 2026 outlook that I've been looking at, and I want to kind of hit some big themes and most importantly, translate what this kind of soothsaying should mean for your retirement income, your investments, as well as your peace of mind. Now, spoiler alert, this is not about guessing the exact level of the Dow. I don't play that game. Instead, it's about making sure your plans work no matter what 2026 throws at us. So let's start with the obvious question. If predictions are often wrong, why do we even read them? Well, here's the thing, the point isn't to worship anyone's forecast. The real value is using these outlooks as a planning framework. They really force us to ask what could go right, what could go wrong, and how would my retirement plan hold up in either of those worlds? So I want you to think of this as less fortune telling and kind of more like a weather outlook. If the forecast calls for sun, you still pack an umbrella just in case. If it calls for rain, you don't cancel your life, you just plan around it. So, here are a couple of the key themes for 2026 in plain English. First, I want to talk about the stock market. The outlook, it is not calling for a massive 20% crash in the stock market next year. Instead, it expects the usual bumps and pullbacks, including the possibility of maybe a 10% decline at some point, which is completely normal stock market behavior. Now, that's just the price of being an investor, right? There's also the expectation that it won't be the big tech names this time doing all the heavy lifting. The idea is that more of the so-called other 493 companies of the S&P 500, well, they could finally start pulling their weight. And if AI and other technologies spread more broadly through the economy, that's exactly what should happen. Now, for you, that means we want to stay diversified, not just chase the seven hottest names that we see on TV or read in the Wall Street Journal. All right, next, let's focus on the economy. The base case for 2026 is no recession. Now, the outlook calls for economic growth that's a bit stronger than 2025, really helped by better productivity and ongoing investments in technology. And job growth, it's expected to be positive but slower, something like 100 to 150,000 jobs per month. Now, just so you're aware, that's not boom times, but it's plenty strong enough to support businesses and earnings, and I think most importantly, your retirement income plan, as long as it's built thoughtfully. Now, let's talk a little bit about inflation and interest rates. On the inflation side, the outlook is actually fairly encouraging. Instead of the big price jumps that we've all felt over the past couple of years, inflation, well, it's expected to drift down from around 3% toward the low to mid 2% range in 2026. That's the kind of environment where your grocery and travel costs, they're not jumping every time you blink, and your financial plan can be built really on more reasonable assumptions. Now, as for interest rates, the view is that the Fed is most likely done with the big moves. The Fed funds rate stays somewhere between 3 and maybe 4%, and the overall Treasury yield curve, well, it doesn't swing wildly higher or lower. So, what does that actually mean? I know you're asking that. It means that cash is probably not going to pay what it did at peak rates, but we're not going back to zero interest rates either. Now, one other area that we want to flag as a potential trouble spot is private debt. Now, that's things like private credit funds that lend money in ways that are not as transparent or liquid as traditional bonds. There's been a lot of money pouring into that space. High fees, limited liquidity, and not a lot of pricing transparency. That combination, all of that together, can be a recipe for a surprise down the road if returns don't keep up and investors all want out at the same time. Now, for retirees, the takeaway is pretty simple. If something sounds too smooth, too steady, too good to be true, that's when you got to be asking more questions and make sure that you understand how an investment works before you trust it with your retirement income. Now, when we're talking about an outlook for 2026, we are also expecting US stocks to outperform European markets again, mainly because Europe is still wrestling with slower growth and demographic issues, as well as higher taxes. Now, we'll see how it plays out, but it's one more reason we often like more of a US centric portfolio for a lot of our clients here in the Charlotte area. And here's a fun side note: Warren Buffett, who many consider the greatest investor of our time, he's set to retire. Can you believe it? Maybe I'll take over for him. Maybe not. He's got some big shoes to fill. But two of his famous lines are a perfect way to think about 2026. First, risk comes from not knowing what you're doing. And second, price is what you pay, value is what you get. In other words, your understanding of your plan matters more than any headline prediction. So, what does all this mean if you're retired or planning to retire soon? Well, first, plan on normal volatility. It happens, but don't plan on perfection. A 10% pullback at some point in 2026 would not and should not be a shock. Your plan should be ready for that without you having to cancel a trip or delay seeing grandkids or panic out of the market. Number two, use this prediction season as a checkup moment. Ask yourself, does my portfolio match my actual comfort with risk? We've got some tools that can help you with that. Ask if your income plan is set up so you can enjoy life, travel, family, hobbies, all of that without watching the market every hour. Also, ask, do I understand what I own and why I own it? All right, third thing I want you to do, focus on those things that you can control. Here's the thing: you can't control GDP or the Fed. You can control how diversified you are, how much cash cushion you keep for near-term spending, how tax smart your withdrawals are, and whether your plan is truly aligned with the life you want in this next chapter. So maybe you'd like to stress test your plan against a no recession but normal volatility kind of 2026, or even a more challenging version of the year. Guess what? We're here for that. Our team at Hobart Wealth can help you see how your income, your investments, and your tax picture all work together so you can spend more time enjoying life and really less time decoding market predictions. You can schedule a conversation with us or just join us at one of our upcoming Hobart Wealth live events right here in the Charlotte area. All right, folks, Chris Hobart here, the Wealthologist. Thanks for hanging out with me today, and we'll see you next week. Have a great new year.